This video is my own reading and analysis of the Berkshire Hathway's 2024 annual letter. I am open to any critique, feedback, and mutual discussion on this. So, to the shareholders of Berkshire Hathway Inc., this letter comes to you as part of Berkshire's annual report. As a public company, we are required to periodically tell you many specific facts and figures. Report, however, implies a greater responsibility. In addition to the mandated data, we believe we owe you additional commentary about what you own and how we think. Our goal is to communicate with you in a manner that we would wish you to use if our positions were reversed. That is, if you were Berkshire CEO while I and my family were passive investors trusting you with our savings. Yeah, this is the way Warren Buffett always, both Warren Buffett and Charlie Munger always expected the annual report to be. This approach led us to an annual recitation of both good and bad developments at the many businesses you indirectly own through your Berkshire shares. When discussing problems at specific subsidiaries, we do, however, try to follow the advice Tom Murphy gave to me 60 years ago: praise by name, criticize by category. What does this mean? Okay, so it's basically something like, let's talk about individuals. When you take somebody's name, don't say bad things, only say good things. When you are praising someone, take their name and praise them. But when you have to criticize, rather than taking their name, you can take their profession. So it will become a category. You are not criticizing one person, you are criticizing the entire group of people who are doing that thing. If you take companies, he can praise companies by name, or he can criticize by their categories, like investment, uh, like insurance companies or banking companies or IT companies or whatever. Mistakes, yes, we make them at Berkshire. Mistakes, yes, we make them at Berkshire. Sometimes I have made mistakes. Sometimes I have made mistakes in assessing the future economics of a business. I have purchased for Berkshire, each a case of capital allocation gone wrong. That happens with both judgments about marketable equities. We view this as partial ownership of the business. So when you buy a certain percent of the companies as shares, you have a partial ownership of a business. Let's say, for example, if you buy 1% of Apple or 10% of Apple, you are 10%. You hold 10% ownership of that business, because shares are not just pieces of paper. There's actual business behind those pieces of paper, and you have ownership claim to those pieces. And the 100% acquisition of companies, those are the companies that Berkshire Hathaway hold uh, individually. At other times, I have made mistakes when assessing the liability or fidelity of the managers Berkshire is hiring. So it's talking about two mistakes. One is where the capital allocation has gone wrong, and the other is hiring wrong managers. The fidelity disappointments can hurt beyond their financial impact, a pain that can approach that of a failed marriage. So, abilities or fidelity. I think by fidelity he is referring to the integrity of the managers. Let me check the meaning. Fidelity meaning faithfulness to a person, cause, or belief demonstrated by continuing loyalty and support. The degree of exactness with which something is copied or reproduced. Yeah, so basically somebody who will not cheat. A decent batting average in personal decisions is all that can be hoped for. The cardinal sin is delaying the correction of mistakes, or what Charlie Munger called thumb sucking problems. He would tell me cannot be wished away. They require action, however uncomfortable that may be. So basically, if you have done a mistake, correct it as soon as you realize a mistake has been committed. During the 19 to 23 period, I have used the words mistake or error 16 times in my letters to you. Many other huge companies have never used either word over that span. Amazon, I should acknowledge, made some brutally candid observations in its 2021 letter. Elsewhere, it has generally been happy talk and pictures. I have also been a director of large public companies at which mistake or wrong were forbidden words at board meetings or analyst calls. That taboo, implying managerial perfection, always made me nervous, though at times there could be legal issues that make limited discussions advisable. We live in a very litigious society. We live in a very litigious society. Is it litigious or litigious? So basically, he's advising that sometimes you don't mention the word mistake or wrong to avoid any legal issues, but they have used this word 16 times, either mistake or error, in their annual reports for these 4 5 years period. All right. So basically, if there is any problem in the company, Berkshire Hathway mentions that in its annual report, but other companies don't really mention that. Most of the companies are using their annual report for marketing purpose. They want to sell their shares, so the price of the share remains high, so the managers can get maximum bonus. All they care about is their annual bonus. At 94, it won't be long before Greg Abel replaces me as CEO and will be writing the annual reports. I don't know how many people would want to read Greg's report. Maybe the large shareholders of Berkshire Hathway will, but I'm not sure other people would be um, would want to read what Greg has to say compared to what Warren Buffett has to say. Greg shares the Berkshire creed that a report is what a Berkshire CEO annually owes to owners. And he also understands that if you start fooling your shareholders, you will soon believe your own baloney and be fooling yourself as well. The next part is Pete Liegl, one of a kind. Let me pause to tell you the remarkable story of Pete Liegl, a man unknown to most Berkshire shareholders, but one who contributed many billions to their aggregate wealth. Oh, Pete died in November, still working at 80. I first heard of Forest River, the Indiana company Pete founded and managed, on June 21st, 2005. On that day, I received a letter from an intermediary detailing relevant data about the company, an RV manufacturer. The writer said that Pete, the 100% owner of Forest River, specifically wanted to sell to Berkshire. He also told me that the price that Pete expected to receive, I like this no nonsense approach. So he just wanted to sell it to Berkshire, and that is my price. Okay, some random price. I did some checking with RV dealers, like what I learned, and arranged a June 28th meeting in Omaha. Pete brought along his wife Sharon and daughter Lisa. When we met, Pete assured me that he wanted to keep running the business but would feel more comfortable if he could assure financial security for his family. But would feel more comfortable if he could assure financial security for his family, wanted to assure financial security for his family. Pete next mentioned that he owned some real estate that was leased to Forest River and had not been covered in the June 21 letter. So he has not mentioned that in his letter to Warren Buffett. Within a few minutes, we arrive at a price for those assets, as I expressed no need for appraisal by Berkshire, but would simply accept its valuation. So, this is one of the things Warren Buffett has talked about earlier, that when other companies acquire uh, Some other companies, they will have an army of lawyers and accountants who'd appraise the business and arrive at a valuation. But at Berkshire Hathway, it's Warren Buffett or Charlie Munger as well. Only these people would just value the company themselves, and if they think the valuation is at a fair price, they would acquire the company. There won't be other people advising Warren Buffett what to do and not to do. This is something I want to inculcate as well. People who know less about investing than me should not be advising me on what companies to acquire and not to acquire. People who are working for a salary should not be advising me. I should have the the decision for investment should be mine, and I should bear all the consequences of that decision. Then we arrived at the other point that needed clarity. I asked Pete what his compensation should be, adding that whatever he said, I would accept. This, I should add, is not an approach I recommend for general use. Pete paused at his wife, daughter, and I leaned forward. Then he surprised us. Well, I look at Berkshire's proxy statement and I wouldn't want to make money. Well, I looked at Berkshire's proxy statement and I wouldn't want to make more money than my boss, so pay me $100,000 per year. After I pick myself off the floor, Pete added, but we will earn X. He named a number this year. And I would like an annual bonus of 10% of any earnings above what the company is now delivering. Okay, so he asked for $100,000 salary, and any earnings for future years would be more than the current year's earning. He want 10% of that. I replied, okay, Pete, but if Forest River makes any significant acquisition, we will make an appropriate adjustment for the additional capital thus employed. Okay. I didn't define appropriate or significant, but those vague terms never caused a problem. The four of us then went to dinner at Omaha's Happy Hollow Club and lived happily ever after. During the next 19 years, Pete sought the lights out. No competitor came close to his performance. Every company, every company doesn't have an easy to understand business, and there are every company doesn't have an easy to understand business, and there are very few owners or managers like Pete. And of course, I expect to make my share of mistakes about the business Berkshire buys and sometimes err in evaluating the sort of person with whom I am dealing. But I have also had many pleasant surprises in both the potential of a business as well as the ability and fidelity of the manager. And our experience is that single winning decisions can make a breathtaking difference over time. Think Geico as a business decision, Ajit Jain as a managerial decision, and my luck in finding Charlie Munger as one of a kind partner, personal advisor, and steadfast friend. Mistakes fade away, winners can forever blossom. One further point in our CEO selections, I've never looked at where a candidate has gone to school. Never. Of course, there are great managers who attended the most famous schools, but there are plenty such as Pete who may have benefited by attending a less prestigious institution or even by not bothering to finish school. Okay, so what he's saying is school doesn't matter. Your ability matters. If you have learned things either in school or outside of the school, that's all right. There are plenty such as Pete who may have benefited by attending a less prestigious institution or even by not bothering to finish school. Look at my friend Bill Gates, who decided that it was far more important to get underway in an exploding industry that would change the world, then it was to stick around for a parchment that he could hang on the wall. Not long ago, I met by phone Jessica Tonkel, whose step grandfather, Ben Rosner, long ago ran a business for Charlie and me. Ben was a retailing genius, and in preparing for this report, I checked with Jessica to confirm Ben's schooling, which I remembered as limited. Jessica's reply: Ben never went past sixth grade. So many people who have never gone to school, have never had the education, have gone on to build great businesses. So business knowledge is not necessarily acquired in a school or business schools, but it's good to go to a business school and acquire some knowledge, especially about accounting and finance. If you don't know anything from the real world, I was lucky enough to get an education at three fine universities. That's not me, that's in the letter. I was lucky enough to get an education at three fine universities. This is Warren Buffett, not me. And I avidly believe in lifelong learning. I have observed, however, that a very large portion of business talent is innate with nature swamping nurture. Pete Liegl was a natural. So basically, learning does not stop at school, and it doesn't necessarily have to start at school as well. You can learn outside the school as well, like how I'm learning using this letter by using Warren Buffett's thoughts. We should obviously, we should always keep learning something or the other. With time, we will get better. Last year's performance. Now, this is what I want to read. In 2024, Berkshire did better than I expected, though 53% of our 189 operating businesses reported a decline in earnings. We were aided by a predictable large gain in investment income as Treasury bill yields improve. We were aided by a predictable large gain in investment income as Treasury bill yields improve, and we substantially increase our holdings of these high liquid short-term securities. So invested and gained a lot from bonds. Our insurance business also delivered a major increase in earnings, led by the performance of Geico. In 5 years, .coms has reshaped Geico in a major way, increasing efficiency and bringing underwriting practices up to date. Geico was a long-held gem that needed major repolicing. In 5 years, .coms has reshaped Geico in a major way, increasing efficiency and bringing underwriting practices up to date. Geico was a long-held gem that needed major repolicing, and Todd has worked tirelessly in getting the job done. Though not yet complete, the 24 improvement was spectacular. In general, property casualty insurance price strengthened during 2024, reflecting a major increase in damage for convective storms. Climate change may have been announcing its arrival. However, no monster event occurred during 2024. Someday, any day, a truly stagnating insurance loss will occur, and there is no guarantee that there will be only one per annum. Okay. The PC business, property casualty business, is so central to Berkshire that it warrants a further discussion that appears later in this letter. Berkshire's railroad and utility operations, our two largest business outside of insurance, improve their aggregate earnings. Both, however, have much left to accomplish. Late in the year, we increased our ownership of the utility operation from about 92% to 100% at a cost of roughly $3.9 billion, of which 2.9 billion was paid in cash with a balance in Berkshire B shares. All told, we recorded operating earnings of $47.4 billion in 2024. See, there is a company out there which is earning $47.4 billion in earnings, in real money, in a year. I think Berkshire's total net worth is about $600 billion. No, that's not net worth. That's how much money he is managing right now. So that's publicly held shares plus cash he has right now, about $600 billion. I'm not sure if his operating companies are included in that or not, but his operating earnings are $47.5 billion. So if you take a rough figure of 50 billion, then it's 1 by 12th, or that would be like 8%, right? We regularly, endlessly read, we regularly, endlessly, some readers may groan, emphasize, so we regularly, endlessly emphasize this measure rather than gap mandated earnings that are reported on page K68. Our measure excludes Our measures excludes capital gains or losses on the stocks and bonds we own, whether realized or unrealized. Okay. So when he buys and sells shares of a company, irrespective of whether he has capital gains or losses, he wants to exclude that. Over time, we think it highly likely our measures exclude capital gains or losses on the stocks and bonds we own, whether realized or unrealized. So if he has any capital gains or losses, he doesn't want to include that in the earnings of the company. Over time, we think it highly likely that gains will prevail. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? Though the year by year numbers will swing widely and unpredictably. Okay, so what he's saying is when he's buying shares of companies, he's thinking over time, over a long period of time, say 5 to 7 to 10 years, the shares will go up because the businesses he has bought are good businesses who are going to earn more and more money every year, and therefore at correct valuation the share prices will go up. But within a short period of time, every year the share prices will go up and down. So why include that unrealized gain or unrealized losses as the earnings of the company? Why report that as the earnings of the company or losses of the company? But he has also mentioned realize here. Why wouldn't you mention realized gains or losses as part of the earnings? Though the year by year numbers will swing widely and unpredictably, our horizon, our horizon for such commitments is almost always far longer than a single year. In many, our thinking involves decades. These long termers are the purchases that sometimes make the cash register ring like church bells. But I have this doubt. Why should realized gains be not included as part of your earnings? Here's a breakdown of the 23 to 24 earnings as we see them. All calculations are after depreciation, amortization, and income tax. EBITDA, a flawed favorite of Wall Street, is not for us. Charlie Munger used to say EBITDA is bullshit earnings. Charlie Munger used to say EBITDA is BS earnings. So their operating earnings has gone up from $37 billion to $47 billion. There's an increase in insurance underwriting and insurance investment income. So BNSF is roughly the same. Berkshire Hathway Energy has increased about 50% more. Other controlled businesses is roughly about same. Non-controlled businesses is little less, include certain businesses in which Berkshire had 20% and 50% ownership, such as Kraft Heinz, Occidental Petroleum, and Berkadia. Okay, so I think this income is basically the dividends which they receive and others. This is in millions. So This figure is in million, this is in billion, 1.5 billion compared to 1.75 billion. And this others includes foreign currency exchange gains or losses of approximately 1.1 billion in 2024 and approximately 211 million in 23 produced by our usage of non-US dollar denominated debt. Okay, whatever. I don't understand all of this. I'm not looking at the numbers right now. Surprise, surprise, an important American record is smashed. 60 years ago, present management took control of Berkshire. That move was a mistake, my mistake, and one that plagued us for 2 decades. Charlie, I should emphasize, spotted my obvious error immediately. Though the price I paid for Berkshire looked cheap, its business, a large northern textile operation, was headed for extinction. The US Treasury, of all places, had already received silent warnings of Berkshire destiny. In 65, the company did not pay a dime of income tax, an embarrassment that had generally prevailed at the company for a decade. So they haven't paid income tax for a decade. That sort of economic behavior may be understandable for glamorous startups, but it's blinking yellow light when it happens at a venerable pillar of American industry. Berkshire was headed for the ass can. Venerable meaning venerable, accorded a great deal of respect, especially because of age, wisdom, and character. Okay, all right. So it was a venerable pillar of American history. Was it an American company? I always thought Berkshire Hathway was a British company which he acquired. Fast forward 60 years and imagine the surprise at the Treasury when that same company, still operating under the name of Berkshire Hathway, paid far more in corporate income tax than the US government had ever received from any company, even the American tech titans that commanded market value in the trillions. Is talking about the likes of Microsoft, Apple, Tesla. Can you consider Tesla as a tech company or a car company? Google. To be precise, Berkshire's last year made four payments to IRS that totaled $26.8 billion in taxes. That's about 5% of what all of corporate America paid. In addition, we paid sizable amounts of income taxes to foreign governments and to 44 states. Note one crucial factor allowing this record shattering payment. Berkshire shareholders during the same 65 to 2024 period received only one cash dividend. On January 3 in 67, we disbursed our sole payment, 10 cents per A share. I can't remember why I suggested this action to Berkshire's board of directors. Now it seems like a bad dream. For 60 years, Berkshire shareholders endorsed continuous reinvestment, and that enabled the company to build its taxable income. Rather than distributing cash as dividends, what they have done is reinvested that cash to buy more shares. Well, it's an investment company, it should do that. Cash income, tax payments to the US Treasury, cash income, tax payments to the US Treasury, minuscule in the first decade, now aggregate more than $101 billion and counting. So last year only you paid 26.8 billion dollars, and it is total only $101 billion. So you're saying majority of that came only in last few years. How could that be possible for such a big company? Huge numbers can be hard to visualize. Let me recast the 26.8 billion that we paid last year. If Berkshire had sent the Treasury $1 million check every 20 minutes throughout all of 2024, visualized 366 days and nights because 2024 was a leap year, we still would have owed the federal government a significant sum at the year end. So if they were sending $1 million every 20 minutes, so three checks in 1 hour, 3 into 24, 72 checks in a day, $72 million in a day into 366, they would still be owning some money. We would still have owed the federal government a significant sum at year end. Indeed, it would be well into January before the Treasury would tell us that we could take a short breather, get some sleep, and prepare for our 25 tax payments. Debt and taxes, only two realities of life. You either die or keep paying tax. Where your money is. Berkshire's equity activity is ambidextrous. What does this mean? Ambidextrous. Able to use right and left hand equally well. Designed to be used by left and right hand with equal use. In one hand, we own control of many businesses, holding at least 80% of the investees' shares. Okay, so the controlling businesses, I think a controlling business is where you hold more than 50% of the share, but here is talking about um, companies where they have at least 80% of shares. Generally, we own 100%. These 189 subsidiaries have similarities to marketable common stocks but are far from identical. The collection is worth many hundreds of billions and includes a few rare gems, many good but far from fabulous businesses. So some so this 189 subsidiaries are similar to marketable common stocks but are far from identical. The collection is worth many hundreds of billions and includes a few rare gems, some very, very good, fabulous companies, many good but far from fabulous businesses, and some laggards that have been disappointments. So, some very, very good companies, some good companies, and some not so good companies. We own nothing that is a major drag, but we have a number that I should not have purchased. In the other hand, we own a small percentage of a dozen or so very large and highly profitable businesses with household names such as Apple, American Express, Coca Cola, and Moody's. So, Berkshire Hathway owns a percentage of this large publicly held companies. Many of these companies earn very high returns on the net tangible equity required for their operations. They have high return on equity, high return on tangible equity, high return on tangible equity. Tangible equity is if you take total equity and minus intangibles like goodwill and other intangible assets. At year end, our partial ownership holdings were valued at $272 billion. Understandably, so he holds shares owning $272 billion. Partial ownership holdings were valued at $272 billion. Understandably, really outstanding businesses are very seldom offered in their entirety. Great businesses are not offered in their entirety, but small fractions of these gems can be purchased Monday through Friday on Wall Street, and very occasionally they sell at bargain prices. But when they sell at bargain prices, you need to have cash to buy them. We are impartial in our choice of equity vehicles, investing in either variety based upon where we can best deploy. We are impartial in our choice of equity vehicles, investing in either variety based upon where we can best deploy your and your family's savings. Often nothing looks compelling. Very infrequently, we find ourselves knee deep in opportunities. So that very rarely happens. I think the last time it happened was the period from 2008 to 2010, 11, 12. Greg has vividly shown his ability to act at such time, as did Charlie. So that period from 8 to 2012, that was a period where a lot of businesses would be very cheaply available. But I think during other times, there are pockets of the stock market which has been ignored by uh, vast majority of investing public, and therefore those are available for cheap. And one such field I believe are in non-renewable sources of energy. Everyone is so focused on renewable sources like solar and electric vehicles and wind energy and whatever. People have completely looked away from oil and gas and coal, and most of the coal industries in the or most of the coal mines in the west have completely shut down, whether in Europe or in North America. But I think coal is doing very well in places like China and India, and those companies are available at very very cheap prices. For example, in India, the Indian government forecasts that in by 2030 more than 50% of the total energy produced in the company would be by using coal, and that total amount would be greater than what uh, coal produced energy is today. So in sense, more coal would be used in 2030 than it is now, even though in the total percentage it will drop from current 80% to over 50%. So the new sources would come through renewable sources, but the coal industry itself is not getting shut down. And the coal we buy from outside, from countries like Australia, is very expensive, even though it's better quality coal. But the coal we have in India is cheaper, and we don't have to pay dollars for that. The Indian power companies can buy it in Indian rupees. So I think there's a very good opportunity in that field, but it's mostly looked away by people because they want to invest in electric vehicle companies and renewable sources of energy, which is very very expensive right now. Greg has vividly shown his ability to act at such times, as did Charlie. With marketable equities, it is easier to change course when I make a mistake. Berkshire's present size, it should be underscored, diminishes this valuable option. We can't come and go on a dime. Sometimes a year or more is required to establish or divest an investment. So it takes more than a year or so to buy shares of a company without raising its prices overnight, or to sell all of the shares of the company. Is he hinting at selling the shares of the Apple? Because he has been selling shares of the Apple for a long time, bit by bit. Additionally, with ownership of minority positions, we can't change management if that action is needed, or control what is done with capital flows if we are unhappy with the decisions being made. With controlled companies, we can dictate these decisions, but we have far less flexibility in the disposition of mistakes. In reality, Berkshire almost never sells controlled businesses unless we face what we believe to be unending problems. An offset is that some business owners seek out Berkshire because of our steadfast behavior. Occasionally, that can be decided plus for us. Occasionally, that can be a decided plus for us. Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. While our ownership in marketable equities moved downward last year from $354 billion to $272 billion, so we sold about 38 plus 54, that would be 40, $92 billion, not 92, 80 something, right? 28 plus 54, so 30 plus 52, that is $82 billion. The value of our non-quoted control equities increased somewhat and remains far greater than the value of marketable portfolio. So when people talk about Berkshire Hathaway, no one talks about the market value of their controlled businesses or businesses they own outright. If those stocks were trading at the market and you take a PE of 10, maybe 10 or 15, then what would be the total value of that holding? No one talks about it. It's only recorded as the book value. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or only partially owned. So he's saying he's favoring good businesses, buying ownership of if you have cash, use that cash to buy ownership of good business, whether it's fully controlled, so you buy the entire business, or it's partially owned by buying the shares of the company. That is better than owning that is better than to prefer ownership of cash equivalent assets, that is cash and bonds and fixed deposit or term deposit in banks or whatever. Paper money can see its value evaporate if fiscal folly prevails. Folly means foolishness, lack of good sense. In some countries, this reckless practice has become habitual. So countries keep printing money like there's no tomorrow for last few years. US is doing that. The total, if you look at their M1 number, that is the money that the Fed has printed, it has gone up from $3 trillion up to the $9 trillion after COVID. Now it has come down to somewhere near $7 trillion. In some countries, this reckless practice has become habitual, and in our country's short history, the US has come close to the edge. Fixed coupon bonds provide no protection against runaway currency. Businesses as well as individuals with desired talents, however, will usually find a way to cope with monetary instability. Businesses as well as individuals with desired talents, however, will usually find a way to cope with monetary instability as long as their goods or services are desired by the country's citizenry. So, if you have something to sell to people, whether you are a business or individual, and if people desire that, then you don't have to worry about inflation, because as Warren Buffett himself has said before in the annual meetings, that people will part away from a portion of what they have to get from you a portion of what you own. So they will be ready to buy something for you, and they will give you inflation adjusted prices if whatever you have is desired by the public. So too with personal skills. Lacking such assets as athletic excellence, a wonderful voice, medical or legal skills, or for that matter, any special talents, I have had to rely on equities throughout my life. So he's talking about himself. He's saying that he doesn't have any athletic excellence, um, neither a wonderful voice to become a singer or medical or legal skills. Those are high earning professions in US, or for that matter any other special talent. So he relied on equities throughout my life. See, this is the key. He is using a bit of humor, but this is the key. If you want to get rich, you need to own equities. Equities are part of the business. Those business are producing something every year and selling it to the customers and making profit. That profit can be distributed to the owners of the company via dividend. Company can have 100% payout ratio sometimes, or mostly companies retain that earnings and reinvest it to produce more profits for the next year. But the way to get rich but the way to get rich is through equities. If you have excelled in athletics or in any other famous sports, it's good for you. You can become millionaire very fast. Same goes for singers and actors. I think doctors and lawyers don't earn as much as the actors and singers or entertainers, as we can say these days. But an average doctor or an average lawyer will have a much better life than an average singer, I would say. If you are best in entertainment field, you will be billionaire. But if you are an average, you won't be earning as much as an average doctor or a lawyer or maybe an accountant. Not an average accountant, but I think the best accountants will earn a lot. I've had to rely on equities throughout my life. In effect, I have depended on the success of American businesses and I will continue to do so. One way or another, the sensible, better yet imaginative, deployment of savings by citizens is required to propel an ever growing societal output of desired goods and services. So every year, people desire more and more goods and services. And so, to produce those, it is important to deploy your savings by the public to produce more. Not everyone is investing, so those who invest will get the benefit of that. This system is called capitalism. It has its faults and abuses, in certain respects more egregious now than ever, but it can also work wonders unmatched by other economic systems. So basically, he's saying capitalism is better than socialism or communism, even though capitalism has its fair share of faults and abuses itself, more egregious now than ever. Egregious. Egregious meaning understandably bad or shocking, means very bad. America is Exhibit A. Our country's progress over its mere 235 years of existence could not have been imagined by even the most optimistic colonist in 1789 when the Constitution was adopted and the country's energies were unleashed. True, our country is in its infancy, sometimes True, our country in its infancy sometimes borrowed abroad to supplement our own savings, but concurrently we needed many Americans to consistently save and then needed those savers and other Americans to wisely deploy the capital thus made available. Save and then invest in businesses. If America had consumed all that it produced, the country would have been spinning its wheels. If America had consumed all that it produced, the country would have been spinning its wheels. The American process has not always been pretty. Our country has forever had many scoundrels and promoters who seek to take advantage of those who mistakenly trust them with their savings. The American process has not always been pretty. Our country has forever had many scoundrels and promoters who seek to take advantage of those who mistakenly trust them with their savings. But even with such malfeasance, which remains in full force today, and also much deployment of capital that eventually floundered because of brutal competition or disruptive innovation. So, it's talking about three things. One is the management or promoters who are taking advantage of the people by raising money. Second is the competition. Much deployment of capital that eventually floundered because of brutal competition or disruptive innovation. So there are two factors. One is competition among businesses. The other factor is disruptive innovation. Some new product got innovated which replaced the existing product. For example, television replaced radio, then internet has largely, it's in the process of replacing television. Internet replace newspapers. That is an innovation which replace that product. So two things to keep in mind while investing is competition and disruptive innovation which can replace your whatever your company is selling. The savings of Americans has delivered a quantity and quality of output beyond the dreams of any colonist. From a base of only 4 million people, and despite a brutal war and despite a brutal internal war early on, pitting one American against another, America changed the world in the blink of a celestial eye. From a base of only 4 million people, and despite a brutal internal war early on, pitting one American against another, America changed the world in a blink of a celestial eye. In a very minor way, Berkshire shareholders have participated in the American miracle by foregoing dividends, thereby electing to reinvest rather than consume. Originally, this reinvestment was tiny, almost meaningless, but over time it mushroomed, reflecting the mixture of a sustained culture of savings combined with the magic of long term compounding. Berkshire's activities now impact all corners of our country, and we are not finished. Companies die for many reasons, but unlike the fate of humans, old age itself is not lethal. Berkshire today is far more youthful than it was in 1965. However, as Charlie and I have always acknowledged, Berkshire would not have achieved its results in any local except America, whereas America would have been every bit the success it has been if Berkshire had never existed. So is giving the so is saying the reason for Berkshire's success is America and not the other way around. So basically, Berkshire Hathaway succeeded in America, it would not have succeeded in many other countries. So thank you, Uncle Sam. Someday your nieces and nephew at Berkshire hope to send you even larger payments than we did in 2024. Spend it wisely, take care of the many who, no fault of their own, get the short straws in life. They deserve better is talking about taxes and redistribution of taxes. And never forget that we need you to maintain a stable currency, and that result requires both wisdom and vigilance on your part. Property Casualty Insurance. PC Insurance continues to be Berkshire's core business. The industry follows a financial model that is rare, very rare among giant businesses. Customarily, companies incur cost for labor, materials, inventories, labor, materials, inventories, plant and equipment, etc., before or concurrently with the sale of their products or services. Consequently, their CEOs have a good fix on knowing the cost of their product before they sell it. If the selling price is less than its cost, managers soon learn they have a problem. Hemorrhaging cash is hard to ignore. Hemorrhaging cash is hard to ignore. Hemorrhaging cash is hard to ignore when writing PC insurance. What is PC insurance? Property casualty. When writing PC insurance, we receive payments upfront and much later learn what our product has cost us. Sometimes a moment of truth that is delayed as much as 30 or more years. We are still making substantial payments on asbestos exposures that occurred 50 or more years ago. This mode of operations has the desirable effect of giving PC insurers cash before they occur before they incur most expenses. We are still making substantial payments on asbestos exposures that occurred 50 or more years ago. This mode of operations has the desirable effect of giving PC insurers cash before they incur most expenses, but carries with it the risk that the company can be losing money. So the company gets cash before expenses, but it carries the risk that company can lose money if the expenses is more than the cash they have received, sometimes mountains of money. This mode of operations has the desirable effect of giving PC insurers cash before they incur most expenses, but carries with it the risk that the company can be losing money, sometimes mountain of money, before the CEO and directors realize what is happening. So you are taking the money now, you are taking the cash now, and you have to pay the cash later. But in most businesses, people know how much their expenses are going to be and can price their products or services according to that. Like in manufacturing, you know your labor cost, you know your raw material cost, you know your inventory cost, and other costs. Plant and equipment cost. Certain lines of insurance minimize this mismatch, such as crop insurance or hail damage, in which losses are quickly reported, evaluated, and paid. Other lines, however, can lead to executive and shareholder bliss as the company is going broke. Bliss means it's a good, blissful bliss, perfect happiness, great joy. Certain lines of insurance minimize this mismatch, such as crop insurance or hail damage, in which losses are quickly reported, evaluated, and paid. Other lines, however, can lead to executive and shareholder bliss as the company is going broke. So, why would shareholder be happy about that? Think coverages such as medical malpractice or product liability. In long tail lines, a PC insurer may report large profit but fictitious profit to its owners and regulators for many years and even decades. The accounting can be particularly dangerous if the CEO is an optimist or a crook. These possibilities are not fanciful. History reveals a large number of each species. That CEO can be an optimist or a crook. In recent decades, this money upfront, loss payments later model has allowed Berkshire to invest large sums, that is float, while generally delivering what we believe to be a small underwriting profit. So in insurance, what he's saying is for money upfront, loss payments later. So you are taking the money now, and you will be paying for the insurance later. You have large sums of money, which is he's calling as float, and you can invest this while generally delivering what we believe to be a small underwriting profit. Real profit is very small, but we are reporting a large profit because we are getting the money now and there are no expenses. We make estimates for surprises, and so far these estimates have been sufficient. So basically, he doesn't show everything as a profit, he shows small underwriting profit and they make estimates for the expenses, and so far those estimates have been sufficient, and the remaining money he call as float, large sums of float, and they invest these large sums. We are not deterred by the dramatic and growing loss payments sustained by our activities. As I write this, think wildfires. It's our job to price, to absorb these and unemotionally take our lumps when surprises develop. It's also our job to contest runaway verdicts, spurious litigation, and outright fraudulent behavior. Under Ajit, our insurance operation has blossomed from an obscure Omaha based company into a world leader renowned for both its taste for risk and its Gibraltar like financial strength. Moreover, Greg, our directors, and I all have a very large investment in Berkshire in relation to any compensation we receive. We do not use options or other one sided forms of compensation. If you lose money, so do we. This approach encourages caution but does not ensure foresight. PC insurance growth is dependent on increased economic risk. PC insurance growth is dependent on increased economic risk. No risk, no need for insurance. So, if there is no need, no one needs to take insurance, and so their business will not grow. Think back only 135 years when the world had no autos, trucks, or airplanes. Now there are 300 million vehicles in the US alone, a massive fleet causing huge damage daily. So 135 years ago there were no autos or trucks or airplanes. Now there are 300 million vehicles in the US alone, and this massive fleet is causing huge damage daily. Property damage arising from hurricanes, tornadoes, and wildfire is massive, growing, and increasingly unpredictable in their patterns and eventual cost. It would be foolish, make that madness, to write 10-year policies for these coverages, but we believe 1 year assumption of such risk is generally manageable. So you cannot take insurance for 10 years out. Basically, what he's saying is the insurance company cannot write 10-year policies because you don't know what is going to happen 10 years from now, or for 7 or 8 years for that matter. But we believe 1 year assumption of such risk is generally manageable. If we change our minds, we will change the contracts we offer. So they can give out 1 year insurance, and if you change your mind about the future, you can change the contract next year. During my lifetime, auto insurers have generally abandoned 1 year policies and switched to 6 month variety. So auto insurers, auto insurers now give 6 months policy. So if you pay money now, you have your insurance for 6 months. That is what he is saying. That this is what auto insurers do now. This change reduced float but allowed more intelligent underwriting. No private insurer has the willingness to take on the amount of risk that Berkshire can provide. At times, this advantage can be important, but we also need to shrink when prices are inadequate. We must never write inadequately priced policies in order to stay in the game. That policy is corporate suicide. So I'm not sure I understand all of this. Properly price Properly pricing PC insurance is part art, part science, and is definitely not a business for optimists. Yeah, so what he's saying is you can't be an optimist. Optimist in this case means nothing bad will happen with the insurers, with the insurance takers, not the providers. Nothing bad will happen with people, so you won't have to pay anything. Then 100% of it is your profit. But if you assume bad things are going to happen to their property, wildfires are going to be there, tornadoes are going to be there, and there will be damage caused to their property, and you would have to pay them a sum of money. So if you are a pessimist, then you can price it properly. You can take an amount of money, and you know how much you can make it uh, by investing it, and so you can do your underwriting properly in that case. Mike Goldberg, the Berkshire executive who recruited Ajit, said it best: "We want our underwriters to daily come to work nervous but not paralyzed." All things considered, we like the PC insurance business. Berkshire can financially and psychologically handle extreme losses without blinking. We are also not dependent on reinsurers that give us a material and enduring cost advantage. Finally, we have outstanding managers, no optimists, and are particularly well situated to utilize the substantial sums PC insurance delivers for investment. So basically, I don't understand all of the insurance business, but you get sum of money upfront. You have to invest it to generate returns, and then on some particular day in future, you will have to pay that money back as well. If you have more money coming in through the insurance underwriting and investment, then you have the cash outlay, then you will be making money. But if you have to pay more cash later on, then you have coming in plus investment increase, then you will be losing money. Over the past 2 decades, our insurance business has generated $32 billion of after tax profits from underwriting, about 3.3 cents per dollar of sales, about 3.3 cents per dollar of sales after income tax. So they have written about $100 billion of insurance and have made about 32 billion dollars. So for it to be 3.3, so far they have written about $1,000 trillion of insurance and have made a profit of $32 billion on that after tax. Meanwhile, our float has grown from $46 billion to $171 billion. The float is likely to grow a bit over time, and with intelligent underwriting and some luck, has a reasonable prospect of being costless. So the float is the extra money which they get. It's not their profit, it's the extra money which they have, which they think they may have to pay back later. So right now they have that, they invest that and grow it and then pay that back later. So the profit is very conservative. Berkshire increases its Japanese investments. A small but important exception to our US based focus in our growing investment is Japan. It's been almost 6 years since Berkshire began purchasing shares in 5 Japanese companies that very successfully operate in a manner somewhat similar to Berkshire itself. The five are alphabetically Itochu, Murebeni, Mitsubishi, Mitsui, and Sumitomo. Each of these large enterprises, in turn, owns interest in a vast array of businesses. Each of these large enterprises, in turn, owns interest in a vast array of businesses, many based in Japan, but others that operate throughout the world. Berkshire made its first purchase involving the five in July 2019. We simply look at their financial records and were amazed at the low price of their stocks. As the years have passed, our admiration for these companies has consistently grown. Greg has met many times with them, and I regularly follow their progress. Both of us like their capital deployment, their managements, and their attitude in respect to their investors. Each of the five companies increase dividends when appropriate. They repurchase their shares when it is sensible to do so. So each of the five companies increase dividends when appropriate. They repurchase their shares when it is sensible to do so, not always. And their top managers are far less aggressive in their compensation programs than their US counterparts. Our holdings of the five are for very long term, and we are committed to supporting their boards of directors. From the start, we also agreed to keep Berkshire's holding below 10% of each company's shares. But as we approach this limit, the five companies agreed to moderately relax the ceiling. Over time, you will likely see Berkshire's ownership of all five increase somewhat. Okay, so that now that they are approaching 10% of those companies, the board has agreed uh, to have them buy more of the companies. At year end, Berks, well, the board cannot hold Berkshire from buying more shares of those companies, but it creates a sense of insecurity among them. So when Warren Buffett promises them that he will not increase his limit, it provides them a lot of security about future. At year end, Berkshire's aggregate cost in dollars was $13.8 billion dollars, and the market value of our holdings totaled $23.5 billion. Dollars. Meanwhile, Berkshire has consistently, but not pursuant to any formula, increased its yen denominated borrowings. All are at fixed rates, no floaters. Greg and I have no view on future foreign exchange rates and therefore seek a position approximately currency neutrality. So they have no view whether the yen will go up or go down compared to dollars and therefore seek a position approximating currency neutrality. So they have borrowed money in yen at fixed rates, no floaters. So it won't go up and down with inflation. The amount of interest they have to pay is fixed already. We are required, however, under GAAP rules to regularly recognize in our earnings a calculation of any gains or losses in the yen we have borrowed, and at year end had included $2.3 billion dollars of after tax gains due to dollar strength, of which 850 million occurred in 2024. I expect that Craig will and his eventual successors will be holding this Japanese position for many decades, and that Berkshire will find other ways to work productively with the five companies in the future. We like the current math of our yen balance strategy as well. As I write this, the annual dividend income expected from the Japanese investment in 25 will total about $812 million, and the interest cost of our yen denominated debt will be about $135 million. So in yen, they will be paying, they've borrowed money in yen and they will be paying an interest of $135 million, and they will be getting a dividend of 800. Oh, so borrow in Japan in yen. On that borrowed money, you will be paying an interest of $135 million. Use that borrowed money to buy Japanese companies, and those companies will be paying you a dividend of $812 million. So the net difference between these two, about $680 million, will be your profit from borrowed money. That's smart. The annual gathering in Omaha. I hope you will join us in Omaha on May 3rd. We are following a somewhat changed schedule this year, but the basics remain the same. Our goal is that you get many of your questions answered, that you connect with friends, and that you leave with a good impression of Omaha. The city looks forward to your visits. We will have much the same group of volunteers to offer you wide variety of Berkshire products that will lighten your wallet and brighten your day. As usual, we will be open on Friday from noon until 5 p.m. with lovable Squishmallows underwear from Fruit of the Loom, Brooks running shoes, and a host of other items to tempt you. So basically, it's like a fair. They will be selling their own company stuff there. If you buy, they make profit. Again, we will have only one book for sale. Last year, we featured Poor Charlie's Almanac and sold out. 5,000 copies disappeared before the close of business on Saturday. This year, we will offer 60 years of Berkshire Hathway. In 2015, I asked Carrie Sova, who among her many duties managed much of the activity at the annual meeting, to try her hand at putting together a light-hearted history of Berkshire. I gave her full rein to use her imagination, and she quickly produced a book that blew me away with its ingenuity, contents, and design. Subsequently, Carrie left Berkshire to raise a family and now has three children. But each summer, the Berkshire office force gets together to watch the Omaha Storm Chasers play baseball against a AAA opponent. I ask a few alums to join us, and Carrie usually comes with her family. At this year's event, I brazenly asked her if she would do a 60th anniversary issue featuring Charlie's photo, quotes, and stories that have seldom been made public. Even with three children, Carrie refused any payment for her extensive work. I suggested she and I co-sign 20 copies to be given to any shareholder contributing 5,000 to the Stephen Center that serves homeless adults. Self-autograph. Becky, Becky Quick will cover our somewhat re-engineered gathering on Saturday. Becky knows Berkshire like a book and always arranges interesting interviews with managers, investors, shareholders, and an occasional celebrity. She and her CNBC crew do a great job of both transmitting our meetings worldwide and archiving much Berkshire related material. Give our director Steve Burke credit for the archived data. We will not have a movie this year, but rather will convene a bit earlier at 8 am. I will make a few introductory remarks and we will promptly get to Q&A, altering questions between Becky and the audience. Greg and Ajit will join me in answering questions. You can find the full details. So it's all about annual day. My wise and good looking sister Bertie, of whom I wrote last year, will be attending the meeting along with two of her daughters, both good looking as well. Observers all agree that the genes producing this dazzling result flow down only the female side of the family. Betty is now 91 and we talk regularly on Sundays using old fashioned telephones for communications. We cover the joys of old age and discuss such exciting topics as the relative merits of our canes. In my case, the utility is limited to the avoidance of falling flat on my face. But Bertie regularly one ups me by asserting that she enjoys an additional benefit. When a woman uses a cane, she tells me men quit hitting on her. Bertie's explanation is that male ego is such that little old ladies with canes simply aren't an appropriate target. Presently, I have no data to counter her assertion, but I have suspicions. At the meeting, I can't see much from the stage, and I would appreciate if the attendees would keep an eye on Bertie. Let me know if the cane is really doing its job. My bet is that she will be surrounded by males. For those of a certain age, the scene will bring back memories of Scarlett O'Hara and her horde of male admirers in Gone with the Wind. The Berkshire directors and I immensely enjoy having you come to Omaha, and I predict that you will have a good time and likely make some new friends. So basically, this last part is he's having a laugh, He's having a light-hearted moment about his sister. He often uses his sister to talk about an ideal business partner in Berkshire Hathway who trust Warren with their money. And before that, he has talked about the annual day meeting, which will be held on May 3rd. And then we have his performance, year wise performance. So, this is very impressive. Uh, in the initial years of Berkshire Hathaway, he was making in per se market value of Berkshire rose much more than S&P 500. When S&P 500 fall 12%, Berkshire fall only 3.4%. But on most years, he made much more than S&P 500. And as the years have passed by, you can see in the last few years, Berkshire haven't given as much return as the S&P 500 has, but that is also due to the large size of Berkshire Hathaway, and they can't invest in small companies. So he has no choice but to invest only in large companies and then sit on some cash. Also, he has said in the past that they've made a lot of money and now it's time to uh, save that money. They don't want to lose that money in a downturn. But if you look at the overall gain, Berkshire Hathaway has made a lot more than S&P 500. So if I take a look at the entire letter, it's a small letter, not a very big one. Total, there are 15 pages, and last two pages are about the performance of Berkshire Hathaway compared to S&P 500. So it's a 13-page letter, and on the last couple of pages, he has talked about the annual day and about his sister. And the first couple of pages are about some of the mistakes he has made, then about Pete Liegl, and then he came on last year's performance. I think the only important thing to take away from this letter is the bit he gave about inflation. What he is essentially saying is we shouldn't worry too much about inflation. If you are worth, if your skill is any good, if you can provide a meaningful service or sell any good, people will always portion a part of what they produce to buy a part of what you produce. Inflation is not a worry if you are investing in good businesses. Inflation is a worry if you are investing in bond, especially those who give fixed income bond. If the coupon rate is small, then bad decisions done by those who handle money matters of the country can erode the value of your money due to inflation, and you will lose money in that case. So that's all for this video. If you have any feedback, so if you want to discuss any part of this later, let me know in the comments. So if